Most people approach retirement the same way they approach investing when they're young. They chase outcomes instead of designing systems. That mindset is the root cause of failure. If Elon Musk were forced to explain retirement in first principles, he wouldn't start with ETFs, yields, or market predictions. He would start with a much more uncomfortable question: what conditions cause the system to fail? Because in engineering, you don't optimize for best-case scenarios. You optimize for survival under worst-case stress. Retirement is not a growth problem. It is a system endurance problem. Once you stop working, your portfolio becomes a life support system. It must function every day, regardless of market sentiment, headlines, or macro shocks. If income stops during a downturn, the system collapses. If volatility forces bad decisions, the system collapses. If inflation quietly erodes purchasing power, the system collapses slowly, but just as surely. This is where most retirees make a fatal design error. They build portfolios that look good on paper but fail under pressure. Too much exposure to individual stocks. Too much reliance on timing. Too much faith in advisors who optimize returns instead of resilience. The result is a structure that works only when markets cooperate. Musk would reject that immediately. He understands that fragility is unacceptable. A rocket that only flies in perfect weather is a bad rocket. A retirement portfolio that only works in bull markets is a bad system. The correct objective is not how much can this make. The correct objective is how long can this survive without human intervention. That shifts everything. You stop thinking like a gambler and start thinking like a systems engineer. You prioritize redundancy over excitement. You value predictability over upside. You remove single points of failure. You design for crashes as if they are guaranteed because they are. Market crashes are not anomalies. They are features of the system. Over a 20-30-year retirement, multiple severe drawdowns are mathematically unavoidable. Anyone who designs a retirement plan without assuming crashes is designing a fantasy. Elon Musk's thinking would be brutally simple here. If a retiree is forced to sell assets during a crash to pay living expenses, the system is broken. Permanently. Recovery becomes irrelevant because capital has already been destroyed at the worst possible time. This is why retirement must be reframed as infrastructure, not investment. Infrastructure is built to operate continuously, not impress spectators. It doesn't panic. It doesn't guess. It doesn't need perfect conditions. It just keeps running. That is the foundation everything else rests on. Once the objective is clear, system survival, the next step is obvious. The portfolio must generate continuous output regardless of market conditions. Elon Musk would never design a system that depends on constant external intervention just to stay alive. A retirement system is no different. This is where cash flow producing assets become non-negotiable. Musk understands power systems. He understands grids. He understands that without a stable energy source, everything downstream fails. In retirement, cash flow plays the same role as electricity in a factory or data center. It doesn't need to be spectacular. It needs to be reliable. Most retirees mistakenly rely on asset prices. They assume they can sell a little bit when they need money. That works until it doesn't. In a severe downturn, selling assets is no longer a neutral action. It becomes damage. Each sale permanently reduces the system's ability to recover. From a Musk-style first principles view, this is unacceptable. A system that requires selling core components during stress is badly engineered. The solution is simple, but psychologically difficult: own structures that pay you for existing, not for being sold. Dividend-focused ETFs filled with long-lived essential businesses function like baseload power plants. These companies don't depend on hype cycles or discretionary spending. They sell food, energy, healthcare, logistics, things civilization consumes even when confidence collapses. Musk wouldn't care whether these companies are exciting. He would care about one thing only. Do they keep producing output when conditions deteriorate? History matters here. Businesses that have increased payouts through multiple recessions demonstrate something extremely rare: adaptability under constraint. They survived regulation, inflation wars, technological shifts, and competitive pressure, and still produced excess cash. That tells you something fundamental about their internal structure. In retirement, this layer exists for a single reason: income continuity without forced liquidation. When markets fall, 30 or 40% price volatility becomes irrelevant if the system continues feeding itself. This is not about maximizing yield. Chasing yield is another form of fragility. High yield often signals structural weakness. Musk would recognize that immediately. What matters is sustainable cash generation, not headline numbers. When this layer is correctly designed, something powerful happens. Panic disappears. Decision-making improves. The retiree is no longer reacting to price swings because their basic needs are already covered. At that point, the system stops behaving like a portfolio and starts behaving like infrastructure. And infrastructure is designed to last. After cash flow is secured, the next design problem is shock management. Elon Musk has spent his career dealing with extreme environments, launch failures, production bottlenecks, supply chain collapses. His response has never been denial. It has always been insulation. In retirement, market crashes are not hypothetical. They are mechanical certainties. The only question is how violently they hit the system when they arrive. Most retirees fail here because they confuse safety with doing nothing. Sitting in cash feels safe, but from a systems perspective, it's corrosive. Inflation is a constant background force, slowly degrading purchasing power. A system that quietly decays is still a failing system. Musk would see this immediately. Passive decay is worse than visible stress because it lulls people into inaction. The correct countermeasure is short-duration stability, not stagnation. This is where short-term, high-quality bond structures come in not as a return engine, but as a shock absorber. In engineering terms, this layer exists to prevent resonance. When equity markets oscillate violently, something in the system must dampen that movement. Long-duration assets amplify shocks. Short-duration, high-quality bonds absorb them. Musk would favor this not because it is conservative, but because it preserves optionality. Liquidity combined with stability allows a system to respond intelligently under pressure instead of reacting emotionally. When markets crash, this component often holds value or even rises slightly. That behavior is not accidental. It is the result of capital fleeing uncertainty and seeking reliability. From a first principles view that migration is predictable, this layer serves a critical function. It provides usable capital during chaos. Not for panic selling, but for controlled decision-making. It allows the system to continue operating while other components recover. Without this buffer, retirees are forced into the worst possible action, selling productive assets at depressed prices just to survive. That is not a market mistake. That is a design failure. Musk would never accept a design where survival requires sacrificing the core. Instead, he would isolate volatility, absorb impact, and keep the system intact. This is not about avoiding risk. It's about containing it. And once risk is contained, recovery becomes inevitable instead of hopeful. At this stage, Elon Musk's focus would shift from protection to automation. Once a system can survive and absorb shocks, the next enemy is human error. And in retirement, human error is almost always emotional. Musk removes emotion from critical systems wherever possible. Rockets don't feel fear during re-entry. Factories don't panic when demand fluctuates. Software doesn't second-guess itself in a downturn. Retirement portfolios shouldn't either. This is where automated balance becomes essential. Balanced stock-bond structures are not designed to impress. They are designed to self-correct. When one component grows too dominant, the system automatically reweights. When equities surge, exposure is trimmed. When markets crash, exposure increases precisely when prices are lowest. This is the opposite of how most humans behave. Retirees often do exactly the wrong thing at exactly the wrong time. They buy after long rallies and sell after deep declines. Not because they are irrational, but because stress overwhelms judgment. Musk would see this as a predictable failure mode. Automation solves predictable failures. A balanced ETF functions like autopilot in turbulent air. It doesn't argue. It doesn't freeze. It executes predefined logic regardless of noise. This removes the single most dangerous variable in retirement investing: the investor. From a systems perspective, this layer exists to enforce discipline at scale. It ensures that capital allocation adapts continuously without requiring constant oversight. That matters enormously over decades. Musk would value this not because it maximizes returns, but because it minimizes regret. Regret destroys consistency. Consistency destroys compounding. By delegating rebalancing to a mechanical process, the retiree is freed from daily decision-making. The system operates quietly in the background, correcting drift and exploiting volatility without emotional interference. At this point, the portfolio is no longer something you manage. It's something that runs, and systems that run reliably don't require courage. They require good design. Once a system can generate cash flow and absorb shocks, the next failure point is no longer the market. It's the human operator. Elon Musk has a deep distrust of manual control in high-stress environments. Not because humans are weak, but because emotions introduce latency, hesitation, and inconsistency. In aerospace, that kills missions. In retirement, it destroys portfolios. This is why automation becomes essential. A retirement system that depends on constant human judgment is fragile by design. People hesitate. They second-guess. They react late. And under stress, they do exactly the opposite of what logic demands. Musk would classify this as an unacceptable dependency. Balanced, automatically rebalancing structures exist to eliminate that dependency. These systems continuously enforce discipline without asking permission. When equities outperform, exposure is reduced. When markets collapse, exposure increases. This behavior feels uncomfortable to humans, but is mathematically sound. It embeds buy low, sell high into the architecture itself. Musk's thinking applies perfectly here. If a rule is correct, it should be executed by a machine, not debated by a person. Autopilot exists because humans are bad at flying through turbulence for long periods. Portfolio autopilot exists for the same reason. In retirement time, horizons are long, and error tolerance is low. One emotionally driven decision during a crash can permanently impair the system. Automation prevents that single point of failure. The real power of this layer is not performance. It is consistency under stress. When markets are calm, automation feels unnecessary. When markets are violent, it becomes invisible protection. It forces rational behavior when fear would otherwise dominate. At this stage, the portfolio stops being something you manage. It becomes something that self-regulates, and any system that can self-regulate is dramatically more likely to survive long-term. That's not financial advice, that's engineering logic. At the end of the day, Elon Musk would frame retirement in the simplest possible way. The goal is not to win the market. The goal is to remain operational for the rest of your life. A retirement system is successful only if it allows you to live without fear. Fear of crashes, fear of inflation, fear of running out of time or money. Any system that constantly demands your attention, your courage, or your emotional discipline is already flawed. The system you've just seen is not exciting by design. It doesn't rely on predictions. It doesn't assume perfect timing. It doesn't require you to be smarter than everyone else. It is built on inevitabilities. Markets will crash, people will age, emotions will interfere, and time will pass whether you're prepared or not. When those inevitabilities arrive, this system doesn't panic. Cash flow continues. Stability absorbs shocks. Automation corrects errors. Nothing heroic is required. No bold moves, no desperate decisions. That's the real victory. Elon Musk doesn't design systems so they work once. He designs them so they keep working when conditions are worst. Retirement deserves the same rigor, the same intolerance for fragility, the same obsession with survival. If your portfolio lets you sleep during crashes, spend without guilt, and ignore noise, then it's doing its job. If it forces you to watch headlines, check balances daily, or second-guess your future, it's broken. Wealth at this stage of life is not about acceleration. It's about stability, continuity, and freedom. Design your retirement like a machine meant to last decades. Then stop touching it. Let it run. That's how you outlive volatility. That's how you win.